to this week's Manager's Thoughts with Kelly from Synergy Asset Management. It is November 4th, 2022, so let's get right into it. As a quick market update, as we're beginning the month of November, investors are really paying attention to three things right now. So that's going to be the end of corporate earnings season for Q3 2022, but also what the Fed's going to do in the December and the following FOMC meetings, along with inflation data coming out next week and then again in mid-December, right? So all these data points are going to be really instrumental in driving how the markets do. This week specifically, though, equity markets began pretty flat as investors waited for sentiment from the Fed meeting this Wednesday, but by close on November 3rd, Thursday, the NASDAQ ended down 5.87%, the S&P was down 3.93%, the Dow Jones ended down 2.18%, and the 10-year U.S. Treasury yield ended up about 0.5% following the rate hike on Wednesday. So very volatile, very moving week. This week, the FOMC met for another rate hike decision. So on Wednesday afternoon, Fed Chair Jerome Powell announced another 75 basis point rate hike in the federal funds rate. This was on track with expectations, but this is also the first time in U.S. history of this steep and rapid of a rate hike, and rates have not been this high since about 2007, 2008, right before the financial crisis. So as Jerome Powell was speaking on Wednesday, economists were really cluing in on the press release and looking for clues of what the rate hike might be in December and in the next FOMC meetings going into 2023. So Powell did not give super direct guidance, but his sentiment saying, "We have still some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected." So that was not super hopeful that rates are going to plateau anytime soon, probably later in 2023. Following these remarks, the S&P fell over 2.5% by close Wednesday. So investors are really looking at this rate hike and really honing in on what the Fed may do in the coming months. Just to emphasize that point again, here you can see the federal funds rate upper limit of the target range is sitting about 4% after this week's Fed meeting, and how it has not been that high since before this data here was even released. So that was around 2007, 15 years ago, when the federal funds rate was above 4%. On top of the Fed meeting this week, economists were also looking for Friday's jobs report. So this Friday morning, the U.S. Bureau of Labor Statistics released October's unemployment rate of 3.7%, and this was 20 basis points above last month's September's 3.5% unemployment rate and 10 basis points above expectations of 3.6%. So although being a little bit higher than expected, a 3.7% unemployment rate is still quite low and healthy for the economy, and you can see that in the chart right there of the last 2 years or so. Unemployment rates have been historically very low. And so on top of the unemployment rate, the BLS also reported the non-farm payroll data on Friday as well. This increased 261,000, which was 31% higher than the expected 200,000 increase. So another sign of a healthy U.S. labor market, and especially good given the rate hike situation that we're in. As we wrap up Q3 earnings season, I just wanted to point out that within the S&P 500, earnings have been largely surprising estimates. So here you can see between the 60 to 70% range of the S&P as of Wednesday close has beat their earnings, right? So really great that they're still earning probably a little bit less than the last few quarters, but still earning great profits in the S&P with only about 30% not making their expectations of earnings. At Synergy, here we are always looking at the news about inflation, corporate earnings, economic indicators, and what the Fed is doing as we head into 2023. And for each of our portfolios, as always, we're monitoring and using these economic updates and data points to manage each portfolio per its mandate and its nature to best take care of you, our clients. We're so happy you joined us this week, so thank you for watching, and we hope you tune in next time.